Hi everyone, John here. So today we're going to be trying to build a global portfolio with stocks and bonds. Okay, so let's just start. The way I'm going to structure this portfolio is going to be based off of this index here. So this index here is pretty much all the countries in the world index. So ACWI, that's what it stands for. So All Country World Index. The ACWI captures large and mid cap markets. So 23 of those. Developed markets are pretty much developed. So think about a US, think about a Canada, think about like the UK. That's would be what would be in the developed markets. Emerging markets is pretty much the up and comers. So think about Brazil, India, China. Um, but those are the main ones. So what we're going to do is we're going to start at the global market portfolio, and then based off of what we think or our past history, we're going to change the weights up. So maybe we're going to tilt towards emerging markets. Maybe we're going to tilt towards developed markets. Maybe we're going to tilt towards bonds. Maybe we're going to tilt towards treasury bills. Whatever you think will make us outperform this specific index. And then also what fits our risk tolerance. So we're going to go over the index first, see what it's done in the past, and what we would expect if we were to be invested in this index over the last like 15 or so years. But yeah, so this index covers 85% of the global investable equity opportunity set. So what that means is basically all of the investable equity in the world. So anything that you could buy stock in pretty much is considered within this portfolio. So you're basically investing in Earth with this fund. So we've got 13 years worth of data here. The ACWI, so that's what we're looking at. It's a combination of both the world as well as the emerging markets. MSCI World is basically just developed. I don't know why they call it the world, but yeah. So overall, we've seen that the developed markets have outperformed the emerging markets significantly. Like I'm talking by a lot. Um, the world plus the emerging markets is this blue line. We can see that it's outperformed the emerging markets by a significant amount just because of the weight. So like within this ACWI, there's actually the developed markets as well as the emerging markets, and just because of the weighting heavily tilted towards the world developed market, you see that the emerging markets are just outperformed by ACWI. But anyways, like yeah. So index performance for the last 1 month to 10 years here. So in the last month, we've seen that the world markets, so the developed markets, have outperformed. Because of the weight of the developed markets within the ACWI, you see that the ACWI is 2.57 versus the 2.68 of the developed markets. And what's dragging down the ACWI is really the emerging markets. So you'll see the weights of that shortly here. Annualized return. So 10.15% for the last 10 years. That's pretty savage, to be honest. Like, if you had this fund, your money would have almost 5x if you were in the world markets. And then if you were in the ACWI, you would have been like 4.4x. Dividend yield. So dividend yield is basically what the equities are paying out after net income. So like we'll get over to that one day maybe. PE. So PE is basically price divided by the earnings per share. So the earnings per share is calculated as net income divided by shares. And then this number here is basically saying how much you're paying per earning dollar or unit of earnings. So like for every earnings that for every I'm just gonna talk in Canadian because like I'm a Canadian. But yeah, so you're paying 21.43 per dollar of earnings. Um you can see that the emerging markets are way under than that of like the developed markets. Like people are valuing $1 of earnings in the world market way more than $1 of earnings in the emerging markets, and that's for a couple different reasons. But like think about it from my perspective. If I was like thinking about it as a perspective of risk, so like the riskier that earnings is, maybe I'm willing to pay way less for it, right? So that's why like I mean, that's like a factor. But there's a couple different things that go into PE, but we can go into that one day. And then price to book value, that's basically like what's the book value of the assets? So assets minus liabilities. And then what's that divided what is the price divided by that number? So like this is basically saying this like the stock of like the world markets is way more than that of the emerging markets by almost double. So there's a couple of different factors going into this. So maybe the PE of the world and the price to book value of the world is higher for a couple different reasons. So maybe like the emerging markets, people are undervalued or like valuing it less because it's more risky. Um, Maybe people are valuing the world markets more because there's more growth opportunities. They have like a higher competitive advantage, a bunch of different factors, but like that's kind of what these numbers are saying. Um, okay, so this part here, index risk and return characteristics. So standard deviation is basically the how do I say this without saying standard deviation? It's basically the variance of the returns. Like it's hard to explain standard deviation. Let me just use ChatGPT. Um, explain standard deviation. Okay, so standard deviation, statistical measure that represents the amount of variation or dispersion in a set of data values. So what this is basically saying is that your returns aren't very stable the higher your standard deviation is. So like let's say for example, in the MSCI world markets, you're going to see an average return of 10.15, but the standard deviation is basically saying that like the bigger it is, the wider the variance within that 10.15 you're going to get. So like maybe it's 10.15 plus or minus this number here. Where is it? This number here. That's kind of what you're looking at. But this is like a big measure of risk because you'll see that like a stock has way higher standard deviation than that of a bond just because of like a bunch of different factors. Mostly, yeah, just a bunch of different factors. We'll get into that one day. Sharpe ratio, that's basically, how do I say this? Risk adjusted returns. So it's basically the risk free rate and that risk-free rate is based off of this. So like the risk-free rate is basically, it's risk-free almost. I would say it's risk-free almost just because of who's issuing it. But yeah, so this Sharpe ratio is the return of the market minus a risk-free rate divided by the standard deviation. So what this is basically saying is that like the higher the Sharpe ratio, the higher your market return minus the risk-free rate is per unit of standard deviation. So like we're looking to have the highest standard deviation possible. Or sorry, not the highest, the highest Sharpe ratio possible. And you can either get that by juicing returns or reducing standard deviation, right? And we're gonna do that by adding stuff that kind of offsets or has like negative correlations. Like we're gonna get into that. Top 10 constituents. So there's 2,800 people, 2,800 different equities in here. Some people are massive. Some people are still big, like $100 million company. But okay, so the top 10 right now is dominated by the US. So Apple, Nvidia, Microsoft, Amazon, Meta, Alphabet. I mean, like they're the same thing, I think. Eli Lilly, Taiwan Semiconductor, and Broadcom. So like all of these are pretty massive. They're all based in the US, all tech. So I mean, it's funny how Amazon is consumer discretionary. I mean, I guess it is, but most of its business is tech now. But we'll get into that. Key exposures that drive risk and returns. So these are basically factors that if you go into them, sometimes how do I say this? Like these factors specifically are known to pay. And you pay with risk. So these are so there's something called a risk and return matrix. But basically the gist of it is like the more risk you take, the more return you get. These specific factors, by leaning in towards these, you take on a little bit more risk, but you do generate a higher risk adjusted return. So like we'll get into that. I mean, not really, but these returns have in fact paid a premium if you take a risk. Like they're like paid. Like you get something for taking a risk by going into like a value stock. Okay, so global sector weights. So we've got 25% in IT, 16% financials, healthcare 11%, industrials 10, consumer discretionary 10. Cool. Whatever. Country weights: US, Japan, UK, Canada, France, other. Great. We'll figure out how to do that. By the way, say hi to ChatGPT. I'm gonna be using it pretty heavy. Okay, so a thing that I kind of missed on was this max drawdown factor, right? So this max drawdown factor basically says that at the highest point of your at the highest point of your portfolio, this would have been the biggest drop. So imagine you have a portfolio of like $1. At some point in history, if you were invested in the emerging market between 2007 to 2008, you would have experienced a drawdown of 65.14%. So basically what that's saying is like your dollar became 35 cents. It's kind of crazy if you think about it. Imagine this, right? So like right now, what's the market cap of this? But basically, imagine this is in millions, right? Imagine all of this, the market cap of the index. So $76 million dropped 65% overnight. I don't know, man. I'm gonna find a way not to have that happen. That's kind of a lot. Like I'm not really that good with that. Like the ACWI, so it's just as bad. I mean, it's not just as bad. It's like 7% less max drawdown, but like imagine you have $1 million and then the next couple of years, like to get from that $1 million back to $1 million takes 2 years straight. Damn. Then on top of that, your $1 million went from 1 mil to 400K for 2 years. And it took like 2 years to get back to a mil. That's basically what this number is saying. How long is this video? 15 minutes. But yeah, like, wow. So that's kind of what we're trying to beat. So I'm going to match this portfolio or try my best to match this portfolio based off of my opportunities. So my opportunities is basically the rules of the game. I can only invest in stuff in the TSX. And maybe right now, maybe let's just stick with the TSX. I can invest in stocks and bonds to try to reduce risk and maybe improve returns a little bit, because like 60% drawdowns kind of savage. Like I don't feel comfortable with that. But yeah, so I'm gonna start off with like a little starter portfolio, and then I'm gonna put some money in over time, and then hopefully I try to beat this at least. Okay, so the way we're gonna do that, so there's a couple different ways to do it. But there's actually already equities. I'll open those back up. But we're gonna take this fund and then we're gonna go to ChatGPT to help us out build a portfolio with a similar profile. And then once we get that initial portfolio matching the ACWI, then we're gonna just make up some reasons to pretty much have certain weights. Okay, so give me a ETF trading on the TSX. By the way, I already have a portfolio in mind, so I'm gonna make up reasons to have that exact portfolio. And then maybe on the next ones, we'll see whether or not, like I'll invest like some money, maybe like 10-20 bucks to the $1,000 portfolio, and then I'm gonna like say, okay, out of my current holdings, maybe I'll put more into this, or I'm gonna put a new holding in. But we'll go from there. So give me an ETF trading on the TSX that follows the ACWI index. Okay. What the heck? Gotta click that. On you. By the way, I'm using ChatGPT free. I don't know if I wanna. Maybe in the future. Should I consider my ChatGPT fee as part of my expense? Part of my returns, like I dock it from my returns? Nah. An ETF that tracks the MCSI All Country World Index is the iShares Core MCSI All Country X Canada Index. Ah, oh, that sucks. Include Canada. Okay, this is XAW. Bro, this guy ChatGPT is not on a good start, man. I want all the world, including Canada. Come on. Okay, this is what I'm looking for. Tracks the MCSI All Country World Index is iShares. Oh man, I already know. For full global coverage, the iShares ACWI. Okay, I had that open. We're gonna use Morningstar a lot. I like Morningstar. So, okay, ACWI. Is it? Whoops. How long is this video? Damn, 21 minutes. All right. All right. Okay. So what we're looking at is an index following the MCSI ACWI ETF. Okay. So this fund is charging 0.32. So basically what that means is, let's say you had 10K, you're getting charged $32 a year. That's basically what that's saying. That's the first thing I'm looking at. So automatically, I know that this specific fund is not going to outperform this fund just because it's already getting charged through like an expense ratio, right? Okay, let's take a look at the performance. Okay, so when you look at this performance, so ACWI is this index, so made by iShares, and then the red line is basically this fund with no fees, no trading costs, no, it's basically no tracking. So like, you see how MCSI is or ACWI, I mean, like this fund, this ETF is beating somehow the index. That's called tracking error. So in this case, the tracking error is positive. Awesome. Let's see why that is. Is it trading at a premium or something? Anyways, I don't know why the tracking error, it's hard to find out. But yeah, anyways, like this is a good fund to try to beat. Okay. Now let's ask ChatGPT. I'm looking to replicate the ACWI ETF. What are some low MER Vanguard, I just like Vanguard, funds trading on the TSX that I can use to replicate the geographic weights? Okay, so US, we could use VFV. Canada, we can use VCN. Developed, we could use VIU. And emerging markets, we can use VE. And ChatGPT even gives us the weights. So 60% VFV, 3% VCN, 20% VIU, and 10% VE lit. So we've already got something here. What we're gonna do is we're gonna validate ChatGPT just because it's already, I already don't trust it from that initial the initial comments, right? So I'm gonna just look through these and validate some of these. So like, what's the MER of VE? 0.24 VEE, 0.24 versus 0.25. Yikes. Just kidding. That's probably accurate. Oh, interesting. See, I was trying to find this on this one. Premium. What? But yeah, basically like ETFs invest in a bunch of different stocks, and somehow this ETF is worth more than the stocks that it's holding by 0.08. So like you could like what that means is you could short this ETF and then go long all of its constituents and be up 0.08. Good luck doing that though. Okay, so this specific VEE has big tracking error. Like this is the index and this is the ETF. I wonder why that happened, but I don't really care. Maybe there's something better. Maybe there's another fund with lower tracking error. But we'll take a look at that. That kind of sucks. Like that's big. Let's do. Is there a fund similar to VEE trading on the TSX? XEC Vanguard Emerging Markets All Cap ETF. iShares. How long is this video? 30 minutes. iShares XEC. Okay, let's just try to find something with lesser tracking error. I wonder why that is. Like, I'd have to look into that. Weird. I wonder. Maybe I'll do some research for another day. Or maybe I'll just ask ChatGPT. VEE and XCC are underperforming the market index by a lot. Why is that? Slower economic growth? No. Did I? Man. Guys. This sucks. ChatGPT has been sucking, man. Maybe I'm just not asking the right questions. Oh, it's my fault. It's not AI, it's the guy. All right. Okay, the emerging market index. Gosh. Tracking error. MER. Their MER is so low. That 27 bips? That's enough? Okay, well, I'm going with the just because of the MER. So XEC has a MER 27 basis points. V had 25, so I'm gonna go with the cheaper one. Budget. I'm cheap. By 0.2 basis points. All right. Okay, I'm gonna do VE and I'm probably gonna start with these weights, right? So let's validate those weights. So 60% in the US, we can maybe up that by 4 or 5%, right? Canada makes sense, 3%. developed excluding North America. So like in North America, there's 3 countries basically. There's like Canada, US, Mexico. Mexico is considered an emerging market. So developed ex Canada ex NA basically doesn't have these two. VEE. VEE is basically emerging markets. So that's pretty much like, we'll go into that. How much time? I'm trying to keep this under. Gotta hit the gym. Gotta hit the gym at some point. But yeah, okay. So let's start with these weights. I mean, they seem pretty accurate, right? Okay, so now we have this specific portfolio, right? If we basically have this portfolio, like we basically took this ACWI Morningstar ETF. So we basically took this portfolio and then replicated this portfolio ACWI with this portfolio. So basically, instead of buying ACWI and then not being able to allocate the weights that we want it, rather this ACWI is basically following this, right? Now we can chop up, we can like increase or reduce certain weights and still get this. Like basically, if you kind of copied this, you would probably get returns close to this, right? Okay, so a way that we're not going to, a way where I almost said we're not going to have this drawdown, but you never know, right? So the way that I'm going to try my best, like I kind of care about the Sharpe ratio, but really I care about this because like, guys, if you had like 2 mil and that 2 mil went to like 800K, you're quitting. You're dropping out of the market. You're never gonna invest again. So I do not want to ever see this. Like I care about this, but I don't care about that as much as this. This is way worse. This is way worse. So the way that I'm gonna go ahead and do that, reduce the max drawdown, is by diversifying my global stock portfolio made out of these 4 funds using bonds, using fixed income assets. So historically, let's see if ChatGPT can explain it to you guys. Man, ChatGPT is not doing good right now. Stocks. Maybe I'm just not asking it the right questions. Why does adding stocks into, why is adding bonds into an all stock portfolio risk reducing and okay, why am I gonna add bonds? I mean, ChatGPT is gonna answer it, right? Adding bonds to an all stock portfolio helps reduce risk by these couple reasons. Lower volatility. Bonds are less volatile. So basically the standard deviation of bond pricing, bond prices are less volatile. I don't really care about volatility. I'm going to buy and hold most of the stuff in my portfolio. The thing that I'm most concerned about is like a max drawdown of this. Like I'm trying, like who knows, man, maybe this portfolio is going to be $1 million. I don't want to see 600K wiped out in a single couple years. Like that sucks. Diversification. So adding bonds is basically diversifying. So rather than owning the company, you're lending to the company. And that's kind of like a way of diversifying your returns, diversifying like risk profile. You're more senior than stock. So if like the stock were to go bankrupt, you're more likely to get your money back. Different things like that. Income generation. So we're going to get some coupon payments. I don't really care about that. All I care about is total return, by the way. So like just how much money is my money generating? I don't care about like how much yield I'm getting. Maybe we'll talk about that one day. Capital preservation bonds. Whatever. Okay, like most of this stuff is something I don't care about really. But like the main thing is basically lower volatility and diversification, right? So maybe if we saw like a 60% in the equity market, maybe we'll see like less. Hopefully, right? I mean, historically we've seen that. But let's actually ask ChatGPT. Maybe it has information. ACWI dropped max drawdown and what historically is ACWI max drawdown? Let's test ChatGPT first. Is it gonna say like 50, 60, 58%? 58%. Okay, ChatGPT. Oh no. New chat. Oh, I might have to pay. I'm not paying, man. I am paying. Okay. 58%. Give a similar figure, but instead of the equity market, do the fixed income. Fixed income and bonds are like the same thing, but anyways. Fixed income. No, really? Yeah, basically we're gonna buy some bonds. Just a little piece right now. What? Bruh, bull. Okay, let's do VBG. This is the bond in VBU. Let's do VBU. I know some of these ETFs already. But come on, guys. That's crazy. 3 to 5%. Let's take a peek at what that looks like. Okay, so if we were investing in US bonds in the last 10 years, right? Oh crap. So this here is basically when rates, I don't know what that is really. But like this here is when rates kind of increased in 2020 or decreased in 2022, or like I guess people started going back into the stock market and stuff. But yeah, like bro, come on. I don't, the gist of it is like we have to find some fixed income securities that will offset crazy stock market drops, right? So this is the US bond fund. Okay. VFV is the equity S&P 500. So you can see like in certain cases the market, the US stock market would drop by a lot. I mean, in this case 22k to 16k, that's like a lot. And then you could see that the bond only dropped from 12k, like 12k, not even a lot, like 10%, right? So having some bonds in your portfolio will do this, but like you're basically reducing your return, right? So think about it. Like let's say I had 90% in VBU and 10%, sorry, 90% in VFV, which is the SP 500, and 10% in VBU, right? Like I would get the weighted average of these two funds and it would be lower than the 40815. But then during this kind of drop, I wouldn't see a significant of a hit on my portfolio, right? Because like 10% of my money didn't drop the full amount that the SP 500 did, right? Even in here, right? Like, okay, stock market was at a high of 30K, dropped all the way down to 25K, right? That's a lot. That's a lot. But when you look at the bonds, it didn't drop as much. So like at this high, bonds were at 12.1K and they ended up at 10,921K. I mean, that's still a lot. Maybe we'll find a way to reduce that. Like we'll try to find an ETF to hopefully replace that, so that way we can like have our money parked in a nice safe place, man, because I do not want to see drawdowns of 60%, right? But yeah, okay. So the other thing I want to say is I'm based in Canada, so I'm going to weight my Canadian equities a little bit more. But let's get started with our bond mix. So I'm going to do like mostly equities. I'm going to do mostly equities, and then I'm going to do some bonds. So I'm going to like I'm talking like 99% equities and then some bonds, and then just so I can learn more about the market. It's kind of new to me. But this is going to be our initial weights. So we're going to do, oh, you know another sixth thing? We're already probably beating this we're already beating this, right? Hypothetically. Look at the MERs of this. So this MER, the fund of this MER is 32 bips. So 32 bips, basis points. So 1 basis point is 0.1%. 32 bips, okay? If I do the weighted average of 0.9, 0.6, 0.22, and 0.24 based off of these weights, I'm going to get way below 32, right? Like none of these are even 32 bips. So I'm probably going to, I'm not saying probably, but like I hope I can beat the ACWI at least. That's my dream goal, okay? Over a 10-year time horizon, I don't know how long I'm going to have this mutual fund or like this like YouTube fund thing going, but like hopefully over 10 years, I'm going to beat this thing. Okay? If I do these weights apparently, but like I'm going to be trying to, firstly, I'm going to try to reduce my risk so I might not beat this, right? Because I'm already investing in bonds. So this is like an all equity portfolio. I might not beat that, right? The other thing is, I mean, that's like the main thing, right? Like the main thing is this fund is an all equity fund, whereas my fund is going to be like some equity and some bonds. And because of the bond part, I'm gonna outperform. So basically, like I'm gonna be between 5 and 10%. I don't know, like I'm just making hypotheticals, right? But like I'm gonna be between 0 and 20% in bonds. So maybe like at some points I'll be outperforming, but then hopefully I can tactically move back into equities, basically timing the market, and then I'll be beating it. Oh, John, don't time the market. You can't do that. Come on, guys. I'll regret it if I don't try. But this is gonna be our initial weights, okay? Guys, you can time the market. I'm gonna try. But these are gonna be our initial weights. Okay, so let's do. So what's the date today? So today is Sep 23. Let's do market. Day, year. Okay, so VFV, VCN, VIU, and VEE. So this is going to be our initial portfolio, right? Okay. How long is this video, man? Let me look. 45 minutes? Guys, it takes a little bit to make a portfolio. Bear with me, okay? All right, so this is all equities. Let's do equity, 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 equity. All right. Okie dokie. So you've got our initial weights. Okay, and let's copy and paste that down here, and then let's do this divided by the sum of this. Then if error, the financial analyst in me hates seeing errors, man. Okay, all right. Then let's do this. Equals this. Oh man, why does it do that? Whatever. I guess it can't read. Can I make this not bold? Nice. Okay. All right. Let's try it out. Okay, if we have $1 US, okay, let's make this all interest or percents. And let's make this a number. Number, use decimals. Okay, so all right, so let's say we're gonna invest money, and then we're gonna try to come around these weights, right? So like, let's say we have, I mean, I already have a starting portfolio. But I'll tell you like what my starting. Okay, let's just go about this. This is taking a little long, but I'm gonna cheat a little bit. Okay, so I already picked out my 7 initial funds, right? So fixed income, so 3 of them. And let's drag this down a little bit. If this equals 0, then ... Otherwise, B2. And then let's just not HDD these. Shift cells up. Seeing a little bit of my Excel skills. Why is this having error? It's adjacent cell. I don't care. I gotta fix up my Excel. I don't like that. Okay. All right. So this is my initial weights. Okay. So really, if I was only just investing in, save. Let's say we're just investing in these specific 4 funds. This would be like how I would do it. So like, let's say if I had $100 or $1,000, right? So I'd be like 600 into VFV, and then $30 into Canada, 20% into developed, and then 10% into VEE, right? So that's basically how you would do it, essentially, right? I can tell you guys how to goal seek and stuff like that, but really like, make this a K by like equals 1,000 over, let's see, equals this over, like this is how I would do it, right? If I were you guys and you wanted to follow along, so let's say you had less than $1,000, or let's say you had $1,000, right? So you do 1,000 divided by 667, 1.49255. Goal seek this to 1,499 percent by changing this cell. Maybe this will work. Frick. Nah. You'd have to like use these to look at these. Like, nah, I'm good. You can find that out yourself. Sorry, guys. Okay. All right. Oh, that's embarrassing. Okay. All right. So now I'm gonna find some fixed income portfolios. So let's find those. Fixed income. How much time do I have left? I'm trying to go to the gym. 50. All right. Okay. Let's find some ETFs. Find me some ETFs by Vanguard trading on the TSX. Okay, come on. Oh, no. Give me some Vanguard bond funds. Vanguard bond funds. Look at me, I'm a prompt engineer. Find me some ETFs by Vanguard. Vanguard bond funds trading on the TXX, whatever. You can figure that out, right? ChatGPT could figure that out. One that covers Canada, one that covers US, and one that covers global. Enter. Whoa, really? Is that for real? No. Yay. So let's do VAB. So we're gonna add some VAB. And that's gonna be, what is that called? VAB. VAB, this ETF provides exposure. So Canada, VBU, it's US, U dot S dot. Whoops. And then VBG, which is global. XUS. VBG XUS. Okay, so that's interesting. I'll bring that in global. With Canada, right? So global XUS. So basically what that means is everything in the world except the US, which means Canada's in there, right? Let's find out. Let's do this. VBU Vanguard. Okay, fact sheet. MER 23%. Whatever. I'm not going to be able to invest in bonds at anything lower, so that's awesome. The drawdown. Okay, imagine somebody telling you that bonds are not risky when you could have a 13% drawdown. 13.7% drawdown. Like, come on. But imagine, okay, this specific fund drawed down 13.7%, but then if we had VFV, fact sheet, 22%. Wow. So within that 1 year, a bond fund performed like had like a similar drawdown to, I mean, like that's not like this net of expenses basically the return from Jan 1 to Jan 1, right? So within the Jan 1 to Jan 1 period, you could have seen a way worse drawdown, but like the return is 12.69%. That sucks. That really sucks. For But when you bring that and consider this US bond fund, this sucks, right? Like people, like sometimes you're thinking in your head like, man, I should be in fixed income because it's less risky than the stock market. I mean, how do you measure risk? Like, do you measure risk based off volatility? Like, you could have high volatility. Like, imagine you had a fund that on average returned 40% with a volatility, with a higher volatility than, I mean, like, at that point, you kind of don't care. But, like, let's say your standard deviation is like a little bit more. Okay, that's a tangent. But anyways, like I think that the most important thing with regards to risk is not really the volatility of it, rather the drawdown of it. Because like if your drawdown, I mean, volatility is fine, but then like if your drawdown is a lot, you might just quit investing, and that's something you don't want to do, right? And for me, like I would quit investing if I saw a 60% drawdown. Like, I don't know about you guys, but I'm not. Imagine you had a mill and it became 350K and it took 2 years to get back to a mill. Guys, no way. No way. That's tough. That's really hard. But yeah, so we're going to hedge out. We're because of the reasons ChatGPT said, we're gonna add these specific bonds, right? But yeah, like this video is getting a little long, but I already had like a target asset allocation that I purchased today, so I'm gonna put it in here. but now you know what the initial weights of the portfolio is gonna be, and basically like this was copying another ETF, and then we're using these ETFs to copy that ETF, and then we're going to um, offset some of our equity risk by having some fixed income to start with. I'm going to have like a very small amount of fixed income, but I'm probably going to up that. The reason why is because rates are dropping. When rates drop, prices go up. So I think that if I have some fixed income, it'll offset the risk of my equity portfolio because of diversification, but it'll also add as like a little return generator, right? Um, but that's why I'm gonna have some fixed income, and then we're gonna find something with lesser drawdowns. So like I'm gonna add some fixed income into this portfolio that doesn't go down as much as like the VAB, VBU, VBG. And then that's what I'm gonna use to try to time the market. So like I'm gonna go into like something really, really not volatile and less drawdown. And then when the US market drops, and I know it's gonna drop, like I'm trying to have this series go on to see one of those drops. I'm gonna sell that. I'm gonna sell that ETF that's like low risk, and I'm gonna go all in on one of these four. One of these four. Probably America, man. Those guys, they go 9 times. They go down 9 times, but they get up 10. So I'm not hoping for a recession because I don't want to see my money go down, but like I'm gonna try to time the market when that happens, right? I mean, it's gonna happen. Hopefully at some point. Let me fix this. Okay. So, all right, what was I going to do? So, I bought a portfolio today with these weights. So, you've got 743. By the way, these are all Canadian dollars. Let's just call the ticker description. Oh yeah, by the way, this is like this Excel spreadsheet is made from scratch. Um as time goes by, hopefully I show you guys some of the tricks of the trade because I'm in finance. Oh, a little bit about myself. My name's John Peralta. I'm a CFA charter holder. I graduated with a major in finance at the University of Lethbridge. I have 4 years experience as a financial advisor, 2 years experience as a financial analyst, and then right now I'm an asset manager. But anyways, like that's just a little bit about me. But okay, asset exposure. Yeah, I'll show you guys some tricks of the trade. Okay, let's open up what my portfolio is. So starting off with 742.32. I tried to get this as close to a K. 150.85. Try to get this as close to a K, but I'm up a little bit. I'm up a little bit. I'm up like 3%. So DIU. So it's not exactly 100. It's not exactly 1,000. But it's pretty close. VIU 50.61. VEE 66.65. Oh, let's add some decimals. Okay, this is what we care about. Let's highlight. Let's bold. That's all we care about. We're trying to get that to a mil. I hope. I hope sometime soon. Crossing fingers. Okay, VEE. What's that? VEE 66. Oh, did I not add enough decimals? 66.65, 50.61, 10.01. What? I have a stroke? 10.01, 5.0. Oh, what? Where's VIU? What? 50.61. Oh, whoops. Oh, I'm not paying attention, guys. 50.61, 10.01. Wait. Okay, VEE. Let's do this. That was annoying. 66.65. I'm gonna order it by my weight. Just so I'm kind of getting confused. 66.65. 50.61. VAB at 10.01. VBU. Wait. So I have more VBU than VAB. VBU is at 10.01, VAB is 5.01, and VBG is 4.01. Look at that, guys, I'm already up. I'm up 2.9%. All right. But yeah, okay, so this is my initial starting weights, right? But yeah, so let's pretend I'm starting off with this amount. Well, I started off with the K, but I'm somehow at this amount already. Okay. So 72.1% in the US, 14.7% in Canada, 6.5% in emerging markets. I got 4.9% in developed markets, and then I've got some US bonds. Let's put that in there so you guys, it's like easier for you guys to tell. EVG. But yeah, okay, I totally got off topic here. This is one take. One take. I don't have time for more than 2 takes, guys. Keep saying guys, but hopefully all genders watch my chat. Okay, VB. Okay, so we've got 1029.46. On September 23, this is what we've got. Okay, so we're already a little deviated from. Let's see how much time we've got. Got We're 1 hour 5 minutes in, and we finally revealed our asset allocation. Okay, so we've got equity, fixed income. So our equity stake is 98% and 1.8% fixed income. So we're gonna I feel why did I choose these weights, and why are they different than like that XTC or whatever that was? What was that? I think it was AWCI by iShares. Oh, come on. What was it? What was that? Okay. So, okay, let's go back. We're an hour in. So, let's do a review. So, we looked up this index. So, we looked up this index and we were like, okay, let's copy this. Let's make a globally diversified portfolio. So we came to that. Then we looked up this ACWI. It's an ETF, and then we were like, "Okay, make this ETF with these ETFs." And we're already gonna probably, like, if we had these weights, I would say we would beat this ACWI just because of the MER, right? Like our MER is already way less than 32 bips. It's like a third, 2/3 of that. So we're saving like 33% on fees. So we're automatically winning versus this guy. Like this is my enemy. I'ma beat this guy. ACWA, ACWI ETF. I'm gonna try to beat you. Um, but yeah, I'm gonna try to beat this fund. We would get similar returns to this if we were following this weight 60%, 3%, 27%, 10%, right? My weights right now are going to be 72. So I want to overweight the US. Why is that? I believe in those guys. I believe in them. I think they I think they're going to outperform. I think they're going to do better than Canada, the emerging markets, and the developed markets for the probably my entire lifetime. I don't see them stopping unless it's like a Rome type of situation where like the mighty fall. But I don't think that that's gonna happen in my lifetime. At least I hope not, because they're my neighbor. Canada. So I overweighted Canada from 3% to 15% roughly, just because I'm Canadian. You don't have to do that, but I wanna put some money where my country is. That's that that that's called home country bias. Okay, we'll get into behavioral finance. By the way, I'll try to make this a little bit educational, but it's not really educational. It's just for fun. That's another thing. This isn't advice. This is me. Y'all are just watching me. Okay. 72% in the US, 14.7% in Canada because I'm here. So I'm overweighting US relative to the 60% because I just believe in those people, right? I'm upping my Canada stake from 3% to 14.7% because I'm Canadian. I want that extra 10%. I believe in myself. I believe in my peers. I work with some pretty smart people. They're all mostly Canadian and trying to be Canadian. One just became Canadian. Anyways, okay. VEE. Uh, why did I do that? I just feel it's a little risky. I just feel it's a little risky. Look at them. Look at these. Look at these guys. Look at underperforming. Underperforming. I do not want 10% emerging markets right now. But historical doesn't match future, blah blah blah. I just really think that they might continue to outperform, but I want a global portfolio, so I'm gonna have them in here. Okay. But yeah, I'm. We'll see. They're doing decent. We'll go into it next time, maybe tomorrow. But yeah, so okay, I'm underweighting emerging markets, and that's what I use to up my stake in the US and Canada. So I'm basically saying that in the near future, I think US and Canada are going to outperform emerging markets. That's basically what I'm saying. So I'm underweight emerging, I'm overweight North America. Okay. And then I also said that Canada is going to do better than pretty much the rest of developed nations. And I really think that that's because of the US. Just because we're so close to the US, we're basically the same country. So I feel like if the US is doing good, Canada's probably going to do good. They're going to carry us. And I'm going to try to carry them. Like we're on the same team, right? North America for life. I don't see any other continent being better than North America. I hope it's easier in the future for Canadians to go to the US and US to come Americans to come to Canada. I hope that's like I really hope that. Like I want to be able to walk across that border in no time if I have a Canadian passport. I mean, like it basically is like that, but that's one of like if I wanted to see something in my lifetime, I want to see America and Canada come together such that you don't need visas. You just show up. You can work full time anywhere you want. That'd be lit. As long as you're Canadian or American, you can go back and forth. Man, I really want to see that in my lifetime. Make it happen, guys. Or gal. Maybe Kamala Harris is going to win. We've got like a month. I'm going to do a special episode for that. The US elections. Yay. Anyways, I'm trying to make this exciting. This is not a professional podcast. This is a fun podcast. Okay, but yeah, so let me see how much time. 1:15. So okay, we've got these weights and then I'm saying that I'm basically okay, so what this means versus like that other fund, ACWI, this is 100% equities. I'm adding some bonds to reduce the maximum drawdown of this fund and maybe reduce some volatility. Like, but really, my main focus is reducing the drawdown so I don't quit. But yeah, so that's why I have this initial asset allocation, and then I kind of just, I mean, it's a very small portion of my portfolio. So the 10, 5, and $4 that really doesn't mean anything. That's like 1.8%, right? But I mean, it does matter, but it doesn't. But yeah. Okay, so that's the initial portfolio. So to make this global diversified portfolio, we went and found the index. Once we found the index, we found an ETF similar to that index or tracking that index. Then we took that index and then found indexes to replicate that index, which is VFV, VCN, VIU, VE. Based off that list, we then changed up the allocation based off of like our choices, right? Like I already gave my reasoning. And then we also added some fixed income to this portfolio to reduce the maximum drawdown. So yeah, I'll try. I don't know how often I'm gonna do this. Probably I'm gonna try to do it every day if I can, or every day that I can for as long as I can. I'm not making any promises. Okay. But yeah, so 1029.46 is our initial starting amount. We've got our initial asset allocation. I'm going to try to add $10 before every video, like at least $10. Maybe more, I mean like at least 10. That way we always have something to talk about, like, hey, I'm going to take the $10. Where am I going to put it in? And then go from there. See ya.